Episode 68 of Real Talk. This is our last episode of 2024. Can't believe that 24 is in the books. Lot to be grateful for. Interesting year. First and foremost, want to thank all of my guests who've been on the show this year. Want to thank all my clients. Definitely a topsy-turvy year, or couple years, obviously. If you've been listening to the show, we've well documented it. Tale of two halves, right? First half of the year, slow, sluggish, workouts, loan modifications, foreclosures, things of that nature. Second half of the year, it's been very active. Capital markets have opened up, more transactional volume across all asset classes. Still hard to do deals, but there are deals being done, which is good to see. And the overall sentiment around my clients is that they're optimistic about 2025. So whether it's the Trump administration coming in, whether it's interest rates have stabilized, there is optimism that we are going to have an active transactional year. This week on Real Talk, I have my good friend and client Brian Shniderson on the show. He's of Capital 360. Brian is a self-storage expert and owner-operator of all things self-storage. He recently closed on the largest single asset self-storage deal in the country here in Cerritos. And we talk about that, and we just talk about the self-storage asset class and industry in general. I hope you enjoy my conversation with Brian, and I hope you have a wonderful holiday season with your family. Thank you.
Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Hello, welcome to another episode of Real Talk. I'm here with my good friend and client, Brian Shniderson, CEO of Capital 360. Brian, how goes it?
Andrew, hi. Thanks for having me on. Exciting. I'm surprised I'm not the first, but whatever line of succession here in terms of podcasts, I'm excited to be on.
Probably only like 60 some odd people.
That's it. Yeah.
But
I'm in the top 100. So
I've got a list of about 1,000. So you're really in the top 90 percentile. So you should feel really good that you're on.
I'm wondering, I think I could be your first client. If I'm correct, I might have been like the first Sklar Kirsh client, but again, who knows?
I'll have to check our engagement letters, but we've done a lot together, highs, lows, in between,
For
and
sure.
I wanted to have you on just to talk about self-storage. And the more I talk to capital providers, they want to get into specialty asset classes, whether it's senior housing, student housing, small bay industrial, grocery anchored retail, and self-storage. Data centers is another one, but self-storage comes up a lot. Obviously you've been in the business a long time, and I want to get and talk about your background, but just let's talk about just sort of today and how you're feeling about the self-storage market. And is my perception correct that there's more demand into self-storage than ever before?
It's such a unique asset class, and it's such a favored asset class, and it's been that way really since COVID really elevated it. But I think that alternative assets in general right now are where your institutional capital providers seem to be focused. And I think that's because, they've had some challenges, big challenges with the major asset groups, right? Your office, often with the retail, and multifamily has been challenged of late. So, I mean, these are bellwethers, right? I mean, office and multifamily. So then you have to decide, where alternative assets might have made up, 4 or 5% of your overall allocation, do you turn it into more now because of what's taken place? So I think you're absolutely right. I mean, you're seeing it across multiple, both LPs and GPs, but I would tend to say that's what I'm hearing from our institutional partners.
Great. All right. So I'm glad that what you're seeing is similar to what I'm seeing. Let's get into how you got into self-storage. What drew you to that asset class, and at what time period were you doing self-storage deals? When was your first self-storage deal?
I mean, I like to say that I was doing self-storage deals when it was a 10 cap business. Because I mean, a lot of those alternative assets were like that. So I was speaking at and that's kind of where I think you and I really got to know each other. Was we were kind of both on the circuit of doing a lot of conferences and whatnot. And I was at the time I was doing investing in real estate, and then I had a kind of a private money lending fund. And I was doing a conference, I believe it was in Miami in 2010, and I was on a panel on distressed real estate, and met a number of guys on the panel, and got approached by the president of a bank, a small bank located in Chicago. Said, "Hey, if you're around, come on up and see me. I might have some interesting assets for you, some unique stuff." At that time, I was playing around with, I should say, invested in multifamily, condo conversions, hospitality, a number of different product type, but no self-storage. And so when I was in Chicago, this is right kind of 2010, 2011, right after the Great Recession, but it was still being felt. So we were having drinks, and the banker had told me that they had this deal outside of Chicago in one of the suburbs, and it was a brand new self-storage facility, beautiful. They built it for, I think, $13 or $14 million, and the guy had went ahead and defaulted, and would I be interested? So the next morning in the snow, drove out about 20 minutes outside of Chicago, checked out this beautiful facility, didn't know anything about self-storage, and ended up doing the deal. And it was a really interesting deal because it was, the property itself wasn't really in the right area. It was right on a main highway, but the ingress egress was very difficult. So if you got off, you were getting off the highway a couple miles down, and this was in a unique place. So it was only like 20% occupied. So the challenge was finding how we could increase the occupancy in a storage facility that wasn't necessarily in the right location. And so I made it my goal, flew out there monthly, dealt with the on-site property managers, switched that up until we found somebody that made the most sense, and then really just focused on learning the business, and did that over kind of an 18-month period, at which point we were buying from institutional REITs, more storage that they were kind of getting rid of, totally different time. It was kind of non-core to their balance sheet, and we were picking up kind of some C-class facilities in Texas and whatnot. And we ended up selling this asset that we had kind of got the occupancy up, and really substantially increased the NOI. So we did, in my first project in self-storage, went really well. And from then on forward, really understanding the business, I really dove into it.
Yeah. Now you used a word a couple times to describe this facility, beautiful. And yeah. I don't think I've heard anyone describe a self-storage facility being beautiful other than you, not just on this call, but there are other projects where you have described self-storage facilities as being beautiful.
Yeah.
What is beautiful about a self-storage facility?
This is a great question. First of all, if you're in any business, you better love what you do. If not, get out of it and go do something else because life's too short. And I think you agree with me there. So, all of these projects, Andrew, they're like my children. When you start on a self-storage deal, and especially if you're developing it, you've got to find that asset. You've got to do a lot of due diligence on it. Then you've got to kind of circle around, make sure it's going to work in that location, entitle it, capital provider, build it, lease it up. I mean, this is years, right? So it better be beautiful to you. And if, there's got to be components to it that you really like. Now, one of the projects that we built in downtown LA, it took second in design. I forgot which year, like 2018 or 2019 or something. And, for just design. And it was funny because there was a multifamily being built across the street from it. And the guys were saying, your facility, the facade looks better than our multifamily, and maybe we went a little overboard on that one, but it's really nice, color metals, and we had some interesting design concrete, and we just did it it looked really nice. But yeah, the facility in Chicago, as self-storage facilities go, most people that aren't in the storage business think of self-storage like the kind of antiquated public storage facilities used to be, where they take up a lot of space, and it was the CMU with kind of the 1970s paint along it. It's changed a lot, including public storage. The stuff they're building now is really nice. And but I think that's where the mentality often goes. And I'm seeing storage being built all over the country. I saw one being built on top of a brewery, another one that was, believe it or not, mixed in with multifamily in Miami. So this facility that I went and saw in outside of Chicago, they just did a great job on designing it, and it was a good-looking building, and it didn't look like a junky warehouse that took up a lot of space. So beautiful. Maybe I'm reaching, but
beauty is in the eyes of the beholder.
For sure, man.
So walk us through what is the ideal location? What are the factors that you look for when you are trying to find an ideal location for a self-storage development, for a facility, both in terms of physical location, demographics, density, income, all the factors that you're looking for, and say, you know what, this would be a great location for a self-storage facility?
It's interesting. Paradigm has shifted, Andrew, and we are a big user of AI. And so that's changed. If you had asked me the same question a year ago, I would have just said the same thing that had been going on for the last 20 years, right? Which is you kind of look for the disposable income, you're looking for the demographics, you're looking for, the competition within a certain a ring, let's say within a 3-mile radius or a 10-minute drive. And there's all these little kind of boxes that we check. We've now partnered with a couple different groups that are not necessarily software, but are involved in assisting us as AI agents in really locating the type of deals that we're looking for. So I'm complete believer in AI. Matter of fact, I don't really send out emails. Even if I'm sending something to you, document gets uploaded to AI, look at the questions, and then I'll say, hey, Andrew, can you look at this and this and talk with you about it as well. But that's really permeated the way that we're sourcing product.
What is it about that AI is able to do that has changed the criteria of development locations?
Efficiency, just efficiency. The AI agent will know all of what we're looking for. So it's from a zoning perspective, from population, from competitors, et cetera. So all that time, and it is a lot of time, especially, our main focus is here in Southern California, also in Hawaii, but really predominantly here in SoCal, and the zoning is just a mess. You have Yeah, sorry.
Let's talk about that. You and I were intimately involved in a potential self-storage project or an industrial project that we were thinking of converting to self-storage.
Yeah.
In a community here in Southern California.
Right.
There's a lot of talk about cities not wanting or curbing the amount of self-storage. Can you talk about why cities are not inclined to approve self-storage development as much as maybe they used to in the past?
I mean, so the project, we'll name names because it's public record, but the project you and I are talking about was in Thousand Oaks, Westlake in 2022. And unfortunately, we caused a moratorium for whatever reason. They thought that our facility was going to be too big. And so there was an issue, and they've now made it to where it's virtually impossible because the cost to build doesn't matter where you are in LA. It has to hit a certain threshold or it's not going to work. And they're limiting you on that. But the majority, I would say at least half of the municipalities here in LA are zoned out of storage, meaning that, they're going to have an overriding decision on what's going to work and what's not going to work. And so, I think you have to become more creative, really. And I think that's kind of what it comes down to. But doing the due diligence on if a site will work for us, that due diligence comes in three areas. The first is meeting, with the neighborhood council. The second would be with the council district, making sure that that's good. And then the third is with like a zoning administrator or planning. So you got to kind of have, make sure that those three boxes are checked, because it depends on, how long you want to fight for, right? So if it's not by right, or if you don't have buy-in with those groups, then you could be challenged in terms of your development. But this really goes for anything, and it's not just for self-storage. Self-storage, in my view, seems to be the hardest hit in terms of the kind of product that for whatever reason evokes a real negative. Oh gosh, no, we don't want that in our neighborhood. Yeah, you say small nuclear reactor, self-storage, nuclear reactor.
So as it becomes more difficult to build brand new self-storage, have you seen cap rates compress for existing nicer core self-storage product? Because it sounds like you're not going to be able to build as much self-storage in certain locations.
Yeah, I mean, I don't know that I'm the best person to answer that. That's probably more of an advisory with one of the big, CBRE or Newmark or one of those guys. I mean, we just went out on our very, very large self-storage facility here in SoCal, and I got a good idea of the amount of interest even, today. So I can go off of that and say that I wasn't necessarily surprised at the interest in in core urban infill Los Angeles. Now, does that correlate to the Inland Empire or Portland, Denver, or some of these, Austin? I don't think it does. So I think obviously New York City, Hawaii, Los Angeles, and Northern California. I mean, these are very, very high barriers to entry, very difficult to build in. So the second you get certificate of occupancy, you've created that value. How long the municipalities are going to allow that to last, I don't know. And obviously, if you can't build anymore, your cap rate should compress, right? I mean,
yeah.
There was a trade in South Pasadena about a year ago, small storage facility, good storage facility, and that's if there's nothing that can be done to that facility, so it's kind of older and antiquated, and you could be efficient in terms of your property management. But if you wanted to, add on to that, go underground, can't do it. The zoning now, from what I understand, on that facility is they don't want storage there at all anymore. So if you were planning on kind of repositioning, that's not going to happen. So it's those kind of issues that are, that are make it more difficult.
So let's talk about how the self-storage business works for those that are new to self-storage in terms of how the ownership is sometimes bifurcated from those that are the managers. So you have your public storages, your extra space. What percentage of facilities that are branded and operated by those large public REITs are actually owned by those public REITs?
So, great question. So, we've always been known as kind of a mom and pop industry. And
Yeah.
I'm going to try to go back and remember what the statistics I read, but don't quote me on this. But I think there's about 55,000 storage facilities or somewhere in there in the US. And from what I understand, about 30% or maybe a third of that is institutional. And I don't know, you throw the REITs in there. So, a majority just aren't. And when I go to we don't have our own property management group. We use different property managers depending on the site. So we might use a very strong regional, or we might use an institutional REIT. But for that, I think that, in meeting a number of these different owners and in any of these conferences or whatever, everybody's doing all kinds of different stuff, and they have this piece of land and they decide, hey, this looks like a great place to put a storage facility. So they go ahead and build one, and then they, have an institutional kind of player help them in terms of laying it out and the unit mix, and obviously within the lease-up. So it's a different business than, let's say, what I'm doing.
Let's dive into operationally. If you look at multifamily, for instance, and you contrast traditional multifamily versus student housing, the lease-up process is completely different. For student housing, you have one shot. If you're not leased up by, probably by April or May, you're done for the year. And with your students moving in August and then moving out in the summertime. Talk about self-storage lease-up, how long it takes to lease up a facility, and once you have a tenant, what is the turnover?
Yes, some of those statistics I would have to reach out to my staff and get the most up to date. But I mean, what we have going on right now. So we have a property that we just finished building in the San Fernando Valley here in Los Angeles. And it's 200,000 gross, about 150,000 net rentable. And you figure average storage facility in the US is, I think it's around 75,000 net rentable, or maybe less. But ours is twice that size here in LA, but urban infill. And we just finished it. We got certificate of occupancy in March. So we're 7 months, and we're 85% occupied. We had a pro forma of I think 24 months or 30 months. So we're going to just beat that up, and really excited about that we were able to lease it up so quick. There was also another facility that was new, that was down the street, that opened 6 months before us. So you really can't tell. And we use our kind of property management partners to help us, because they have all the data analytics and localized to assist you with this. But sometimes you just can't tell.
Yeah.
And hopefully, did that answer your question? That makes sense.
But what about turnover? Because my sense is once you're in, it's like you never leave.
So the big buzzword around the industry right now is ECRI, which is existing customer rental increases. So that's kind of been happening. You're reading or in the news, and kind of 23 and 24, it seems like you're reading that street rates are decreasing in self-storage. And I think that that's really micro, maybe very general for other areas, but dense urban infill areas. And if you're in, West LA or Santa Monica and you have a legacy asset that can't get replaced, are the rates going down there versus, the Inland Empire where you can build all around. So I'm not sure about that. From what I understand from our properties, our average tenancy used to be around 6 months, and now it's pushing closer to a year. With these ECRIs, I think that's, where people come in on a teaser rate, and then they start getting bumped at 3 months, and maybe month 3, and maybe month 9. So they may be getting 2 hits within a year if they're staying at that facility.
Yeah,
and that's kind of industry wide right now.
So I want to touch base and get into what the next 2 to 5 years, what you're planning for. But before we do that, I know you touched upon this recent sale in LA, in Cerritos, but I mean, it was a monumental sale. I think you said that it could be or is definitively the largest single asset self-storage sale in the history of the United States. In history. So talk about it to the extent you can. Who bought it? If you could talk about cap rates and get into more of the specifics as to what made this transaction such a bellwether transaction.
Yeah. So we, again, that's like a child. So that was our managed by Extra Space. It was a Cerritos facility, and it was almost 300,000 net rentable, making it one of the largest facilities, in the country. Definitely one of the largest here west of Mississippi, and one of the largest here in SoCal. So when we found that property, it's right off one of the large thoroughfares, the 605 freeway, and we were kind of planning this. I was joking because we were trying to sell the dream that it wasn't too big, and if you dropped a pin in a map of LA and Orange County, it's right in the center, and urban infill, and it's always nice to be right 8 years after the fact, right? But we sold into what I don't need to tell you, Andrew, is a very down market, right? And we had Odyssey funds, we had sovereign wealth funds, all the big equity players, everybody was bidding on this, and I was, I wasn't so surprised. I just didn't know how it was going to go with the economy and kind of, capital so hesitant and on the sidelines. It's all over the paper. So it was sold at $91 million.
Mm-hmm. And what is that on a cap rate?
I'm not sure how the cap rates, how it ended up, because the part of the sale was with an expansion of like 38,000 feet. So I'm not sure how that translated.
Got it. All right. So as we're heading, at the end of 24, almost in 25, what is your plan over the next couple of years?
Yeah, well, right now we have a beautiful development that we're working on in Hawaii and Oahu.
Well, you can say beautiful and Hawaii. That I get. Okay. But
yeah, man, it's nice, and so we're really excited about that. We've got another one right outside of Waikiki that we're about to get started on, and then a couple more here in LA. So I think it's an interesting time, and it's interesting because your capital providers are tiptoeing into putting up money for deals, and debt providers are looking and relooking. And thank goodness we're kind of best in class is what we do. We've got a great track record, and I think we're very particular about the kind of sites that we look for, and it's in areas that are, wow, if you can do it there, it's kind of a winner. So I think that on the 2 to 5 years, hopefully those projects will have been built and be in lease up. And I think that's just kind of our model. We're not one that's going to be the biggest builder or a mass builder. We're not looking at rolling up facilities in the Southwest with mom and pops or anything like that. We're very particular. We do an incredible job in our developments. We're very particular about what we build. We do build very large, and we try to get into very high barrier to entry markets. So we kind of put a lot of impediments in front of us, but when we do have a project, it's almost ends up being like 4 projects between LA and New York.
Yeah, and look, you've had different type of capital partners, institutional, syndication, high net worths. Do you have a preference as to how you capitalize deals?
That's a really good question, and I think it's almost like dating and having a girlfriend. At different times of your life, I think different people might make the most sense, right? And I think it just depends on the type of project, what the environment is, and what you feel, where you're at in your career or where you're at in your cycle, that how and who you want to partner with. But obviously, and you've seen it, Andrew, and I could throw it back at you and say, what do you think? But look, the right partner, it's not necessarily about making the most amount of money with your partner in the splits. It's about culture, and it's about cultural congruity and your ability to, during COVID, Trump, the Trump tariffs, or any of the major items that we've dealt with, which we had no control over. You have to be able to talk with your partner, and they have to be there for you. And if they're not, you got a big problem. And we've had, knock on wood, which I think this is wood, but not on wood, but we've had really good success over the past kind of 10 years with our institutional partners, as well as our debt providers, where when there's been an issue that has come up, and in LA, I think you remember, we had one of our projects, we're right in the center of it, after we had all of our B permits, and we're already, we're in the ground, we're building. There was an overlay in LA, and the city came to us and said, well, we're going to want you to put a stoplight here, and we're going to want you to half a mile both ways, put sidewalk. It was like to the tune of $2 million, and we had to fight that. But, that was nothing that we could have prepared for. But again, our, capital partner and our debt partner were like, let's figure this out. So.
Yeah. Well, what I tell people is, what makes a good partnership is after you've spent, a few weeks, maybe longer, negotiating, I don't know, a 60-page JV agreement.
For sure.
For those that are only listening on audio, aren't going to see this. What you want to do is you stick this in a drawer and never see it again. And if you have to open up that drawer and start looking at major decisions and this and that, and who has rights and defaults and remedies, then the partnership didn't go well. And so my hope to all my clients who negotiate those long and intensive, laborious joint venture agreements is you'll never see it. It's just there. It's in a drawer. And Brian, I want to thank you for coming on to the show. You're a good friend and partner and client, and nobody knows self-storage better than you do. And
I don't know about that, but
how about you were what, the top 60, 65 people of Real Talk? You're one of the top 60 to 65 operators or owners, developers of self-storage.
Well, Andrew, I want to thank you, and honestly, and you've saved me from so many what I like to call holes covered with leaves that we didn't fall into because of your experience and really your staff and everything. So, back at you.
No, I really appreciate it. Continued success on those beautiful, you sound like Trump with the beautiful wall, the beautiful self-storage facility. And I will check out the one in Hawaii. That
for sure, man.
definitely deserves its beauty.
Right.
Brian, thank you. I appreciate you coming on. Thanks.
Okay. Thanks, Andrew.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.